Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C from the CNBC TV18 Prime Ionic Wealth Angel One Studios. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. Well, a quick read through, first of all, of the global equity markets and the major U.S. indices, along with the small cap Russell 2000 index, posted big losses on the day of Thursday to close out one of their worst one-day performances since the month of October. The Dow Jones Industrial Average lost about nearly 800 points or 1.7%, taking back gains seen in Wednesday's session when it crossed the 48,000 levels therein. The stocks across Asia-Pacific are mirroring those cuts on the Wall Street as the tech rout happens and deepens, and hopes around the rate cut from the U.S. Federal Reserve seems to be fading right now. Back home, it's choppy day so far on Dalal Street, where Nifty is hovering around sub-25,900 levels. Joining us now is the first guest of the day. Dev Gill is head of sugar at Marex. Dev, hi, thank you so much for joining in. And this is one subject that clearly has been buzzing quite a bit. Your first sense on the sugar prices itself, which are trading at a multi-year lows in the international markets, holding around that 15 cents or thereabout. What is it that you're watching in sense of fundamentals onto this one, apart from the fact that, of course, this is going to be a surplus year?
Thank you, Manisha. I think one of the things we're looking for right now is the fact that, as you say, we're at kind of multi-year lows on the prompt of March futures flirting with 14 cents. For us, there are a number of different things that are, kind of contributing to the current price and why we think that it's an extreme on the low side. One of them is obviously the COT shutdown. Obviously, the government shutdown is now over, and we'll be expecting the commitment of traders reports to show extreme near record short kind of levels, around 220,000 contracts as of now, that we think that the speculators are overall short. We also see that this expectation that India is going to export 1.5 million tons, or allow for that 1.5 million tons to be exported, will be officiated very soon in the next couple of days. And so we go from buy the rumor, sell the fact, because ultimately the export parity is not connecting with the world market today when we look at what the domestic price in India is trading. So there are a number of different elements there, and the fact that when we look at some of the Brazilian data that's due out in the next couple of days as well, we'll see that there is a move to essentially produce more ethanol in light of sugar prices today. So that kind of turning of a corner, a reduction of some of the supply from Brazil, which has sort of led to some of the kind of, let's say, downfall in the market, will also be, we hope, turning a corner and therefore pointing for kind of a turnaround in prices to some degree.
Dev, this year is ending into negative when it comes to all varieties of sugar, including one for India as well. What kind of surplus is Marex working with? Because whether you look at, various agencies are putting out their numbers, but one thing is for sure, everybody's looking at a surplus. What is your number?
Sure. So we're looking at a surplus of 2 million tons. But again, how you time that is sort of there's a divorce in the market in terms of where people anticipate this surplus and this glut to occur. And that's why we find it to be quite an interesting point of view, especially right now with the extreme of the speculator short and how that transitions as we go into Q1 of 2026.
Dev, how are you also looking at the problem of surplus coming in from India as one part of it, which is allowed 1.5 million tons of export, and then you have Brazil, which is making more ethanol from corn rather than sugar. So sugar is more in availability, and so is the case with Thailand as well. So much more sugar. Are we preparing ourselves for a longer-term bearishness within the space?
I think it can be easy to look at forward balances and think there's going to be a glut in each and every part of the world. As you and I both know, weather is a hugely important part of the factor of whether this actually comes and realizes. For the past year and a half, we've had almost perfect weather. And so we are where we are in terms of prices, partly due to these confluence of factors. However, if we look further out, there is very little in the way of weather risk being attributed to prices as things stand. We're also trading and projecting prices in the futures market that are below pretty much every major country's cost of production. If we look at India, whilst we do anticipate and have been anticipating this export decision from the government, if you allow for 1.5 million tons, if the economics do not connect where the domestic price is trading higher than the world market, we don't expect a subsidy for many different reasons. And so the announcement doesn't mean that that actually will flow to the world market. And that's why we're working current prices with around 500,000 to 600,000 tons of low quality white sugar to be provided. And if we look at last year's 1 million tons, or last crop year's 1 million tons, not all of that was provided for the same reasons. The world price just didn't seem to connect with the domestic price. In Thailand, the cane price has been announced this week, which is quite a lot lower than last year. So again, there are signals to farmers, the same in the EU, that there is a control because we have drastically gone, far and away from the and below the cost of production in all these major places. So there are things at the margin that are taking place, but without a doubt, Brazil is a major factor there that you highlight, and ultimately we can't get around the fact that the cane number should be significantly higher than this year. But again, the mix is an important part, and if prices continue to trade at this level, if crude is continuing to trade as it is around 65, then there isn't any reason why we wouldn't see an adjustment of mix for next year that would move somewhat to rebalance the production of sugar and not be an extreme maxi sugar scenario as many are forecasting it to be next year.
Dev, I take your point well when you say that most of the countries right now are producing, selling sugar below cost of production. That is true for India, and that perhaps is true for various other producers as well. In light of all of that, what kind of sales do you see coming in for the markets? Second is, what is your sense now for the raw sugars? Because when 2025 started, nobody really predicted these kind of prices where you could see them going below 16 and 15 and trading below that for the very long time now.
I think one thing that we've seen as a vindication for the function of price is that China stepped in the October futures expiry. And again, the function of price for China is to stock rotate and import when prices are low. The arbitrage was open for the domestic refiners to import when the market went below 15 cents. That happened in size, and it's reassuring for the market to see that when you reach these sort of so-called extreme prices on the downside, that large governments take note and realize this is an opportunity for them in order to take advantage of low prices. So we do see offtake, we do see interest at extreme prices, and if we are looking now toward the end of the year, where we are going to see COT reports catching up, we do see every chance that the market will project, and we might be able to test the next key technical area and engagement point for the commodity trader advisor kind of levels, which is around 1580. So if we see that and we go beyond that, again, that's a big if, and it depends on the producer pricing. Producers are poorly hedged overall. Then that there is every chance of a sustained rally. However, our first ambition is really to see market to rally to 1580 and see if we can overcome that hurdle and see some adjustments with the short term, especially the short term systematic trading fund short covering.
Dev, what is it that you're going to be watching out from here on? Is it going to be the CFTC data, which, as you said, the markets are awaiting? Is it going to be the crude oil prices? Currency plays an important part as well when you look at sugar from various producing nations there. Or is it going to be pure demand going forward?
It's not one single factor. The COT is definitely a major factor. We're looking at the UNICA numbers, which are the bi-weekly Brazilian numbers, to show that change in mix as we're 2 cents away from ethanol parity, trading 2 cents below ethanol parity this year. So in essence, reducing the amount of sugar production in favor of ethanol production in Brazil. We are seeing the TCH, which is kind of the quality of the cane, reducing at the moment in the month of October, which has been confirmed by the CTC data that we have available. So there are a number of different factors that I think this week and next week will sort of confirm that the deterioration in the quality of the cane in Brazil, alongside the price signaling around sugar, the sugar mix, is changing, and therefore that and a seasonal likelihood when you have extreme positioning on a historic basis of adjusting that is interesting. We're also looking at the rebalancing of the major indices that typically takes place in the month of January each year, where commodity prices are obviously adjusted on a historical price. There would be around 50 to 60,000 contracts as of current prices. We project that will be bought in the Sugar 11 contract in January. So again, confluence of factors that would help to contribute to some sustained momentum, or at least testing some higher levels.
All right, that point is well taken, Dev. Thank you so much for joining in. So that's sugar for you, trading at a multi-year lows, below cost of production for major producers, and trading really on the lower side right now. But as Dev tells us, there's just too much factors to watch out for from here and well. But perhaps we are near bottom when it comes to the international sugar prices therein. Well, thank you so much for your time. And with that, we'll slip into a short break. On the other side, we'll talk all things economy and currencies with Jamal Mecklai, direct to discuss all things. Stay tuned. Welcome back. You're with us on the Big C on CNBC TV18 Prime. Joining us is Mr. Jamal Mecklai, MD Mecklai Financial Services. Mr. Mecklai, hi, thank you so much for joining in. Great to have you on the show here. Before I start, I want to take a step back and look at 2025 overall, a year which has seen US dollar decline, and it's also seen most of the Asian currencies decline as well, including the Indian rupee. That isn't exactly the textbook way of reading it, is it?
No, but in point of fact, the rupee has been the worst performer, right? I don't think some other Asian currencies have declined a little bit, but basically the rupee has been fallen farther than anybody else, largely. And interestingly, as you have seen, it has not really helped exports, right? So to my mind, the issue is certainly not the currency. I mean, there are more fundamental issues holding our exports back. And I think the government really needs to focus on that. It's good they've come up with this plan right now in response to the tariffs, et cetera, But you talk to any exporters, and most of them are a little shy to talk in public, But they all say that the processes, transportation, customs, there's just too much of the old world still there, which is holding exports back. It's not the currencies.
Since you talked about the Indian rupee, and well, yes, it's been the worst performer in 2025 till time. Are you looking at further declines continuing? Is it going to spill over into 2026 as well? There are some banks talking about 89, possibility of a 90 as well.
See, the fact is, in reality, the rupee is on a RER basis when it is rupee is too weak. It should not weaken more. But the point is that as long till the government gets their act together, which is a long ways to the bank, in my view, because the real problem is they're not willing to acknowledge that there are problems, right? They're not willing to acknowledge that, as I said, the rupee has fallen over the last 2 years, and exports have fallen over the last 2 years. So I guess the rupee is sort of tagged, if you will, as the shock absorber in the system. So clearly, most people believe that the rupee will over time keep going down. So I guess, much as I hate to get into that car, I have to feel the same way. Now, whether 89 is around the corner, the one good thing I would say, I don't know if it's true or not, but I felt that RBI actually followed my suggestion. in early October, I said that they should intervene in the NDF market to prevent the rupee from falling further. Because see, the problem with a weak rupee is A, it's not helping exports, but double A, it's keeping prices high. The lower middle class is under a lot of pressure because the cost of oil, the cost of cooking oil, it's not helping. So it's not inflation, it's prices that the government should focus on. And one way to control them is to make the rupee stronger. But again, the RBI did appear to follow me by selling in the NDF. Not that they followed me; they did it on their own. But I mean, I'm not sure. I don't see anything like that happening in a consistent basis.
Mr. Mecklai, also the other one is about the dollar index itself, because that really seems to be moving a lot of markets there. What is your own sense when it comes to the US Fed, whether or not cutting rates in the month of December? What probability are you putting on that? Because we've seen that move from anywhere from 90% to 50% right now.
Yeah, I mean, the fact is, it does look like the US economy is slowing. I mean, the data hasn't come in. The other problem, of course, is that inflation is not coming down. I mean, I think there was one reading which was very, very low. But generally, it's the same sort of situation as in India, different drivers. But see, again, it's not inflation, it's prices. I mean, the US is a very high-cost economy. And so this dream of having companies invest in the US is a pipe dream. The dollar index, I was very proud of myself that I called it, about a year ago, when it was, I think, 111 or something like that. And I saw it coming down. In fact, I even called 97, which is what it hit. It's bounced back, it's been bouncing around between 97 and 100. Frankly, I think part of the whole game is, there's a lot of uncertainty in the US surrounding Trump, right? While shockingly, market volatility is much lower than it was, which suggests that maybe markets are sort of coming to terms with Trump. But my sense is that certainly over the next period, I won't say necessarily the next 1 year, but probably the next 1 year, markets are going to recognize that Trump is, MAGA is having a problem. There's different parts of MAGA are fighting with each other. The Democrats, Mamdani was fantastic. The Democrats are coming back. So if the Trump uncertainty increases again, I mean, gold will, of course, remain high. And inflation will be high. So the dollar index should probably, I don't see it rising very much. Let's put it that way. I don't think it's going to keep falling.
Okay. Mr. Mecklai, also, how are you looking at the overall tariff as a position right now? Because we've perhaps probably spoken the most about tariffs in this year till time. Do you see that situation or that conversation now going to rest by the end of this year?
Well, I would hope so. I mean, Trump seems to say, "Haan bhai, ho jayega." Ho jayega, he's like a Delhi wala. But the fact is, India is no longer that important. I mean, he and China are the G2, as he says. So, I mean, obviously there are enough people batting for India, so there's talk that the tariffs will come back. But again, like I said, the tariffs are also, in my view, not a major constraint on exports. I think it is basic. I mean, of course, they put pressure on exports. But just by tariffs coming back down, let's say from 50 to 15%, I still don't see exports surging, which means the rupee will, as usual, carry the weight.
Mr. Mecklai, you mentioned about gold some while ago, and it really has been the year of gold. We've seen nearly 60% of gains in this year. Silver has been up by nearly 85%. Rupee hasn't done so well. Equity markets, an underperformer, not just within the space, but globally as well. How would you step into 2026 with a similar view, or you think gold perhaps has done what it had to do? We'll see it growing, but not the same performance.
Well, you can't get 60% a year. I mean, give me a break, right? But I think gold, again, what I mentioned earlier about the uncertainty around Trump, which seems to have calmed down, I think that's going to accelerate, right? Because people will realize that, hey, when he goes, whenever he goes, who's going to take over? So there's going to be a lot of uncertainty increasing. Gold cannot fall, right? Because the central banks are buyers, always buyers. And it's gone back up to 4,200. I mean, it's hard to see where it'll go. Some guys are talking about $5,000, but boy, I can't forecast a number, you know. But the reality is gold isn't going to weaken.
As we get into the new year yet again, there is just so much that the markets would be looking at. I mean, it is also going to be about whether or not on how much can India really exports, the kind of FTAs and BTAs that India seems to be doing with various countries also. Would you say that there is a global reset that is happening as we speak right now, and 2026 perhaps could solidify that?
Well, there certainly is a global reset in multiple directions, right? Again, I come back to the point that our problem has nothing to do with global. Our problem has to do with domestic policies and domestic politics, which is focused simply on PR and not on really working to make the economy better, right? I mean, this recent thing of 45,000 crores that has come out for exports, that's over 6 years. Brazil has put in $5.5 billion, which is almost exactly 45,000 crores for 1 year. I mean, the government is not, I mean, doesn't know what it's doing, in my view.
All right. Mr. Mecklai, that's all the time that we have on this show, but pleasure speaking to you and hope to speak to you soon again. So that, of course, is the view coming in for the currency, for tariffs, and, of course, the Indian policies and economics as well. But with that, all the time we have on this edition of Big C. Thank you for watching.